Hey everyone! In today's video, we're breaking down a trading method that uses multiple time frames to execute trades with precision, based on smart money concepts. If that sounds like your thing, don't forget to tap the like button to support the content and subscribe if you're joining us for the first time. We'll catch you right after the intro and the disclaimer. The foundation of a successful trade starts by examining the higher time frames, then narrowing down into the lower ones to spot trade setups. There are three main categories of time frames, each with its own role. First, the higher time frames, like the weekly and daily, help us gauge overall market direction and highlight significant levels. Next, we have the analysis time frames, where we carry out most of the breakdown, applying concepts such as market direction, fair value gaps, order blocks, liquidity zones, and spotting trade setups. Lastly, the entry time frames, typically the 15-minute and 5-minute, are used to confirm our entries before executing the trade. As we start our analysis on the 1-hour chart, the first thing we do is map out the market structure schematic to grasp both the direction and the structure of the market. This schematic is drawn by connecting the lowest and highest visible swing points. For instance, this could represent the structural schematic of price swings for this particular pair. You can also include internal structural elements on the chart if needed. However, the main goal of creating this schematic is to analyze recent price action between buyers and sellers using the line chart to better determine who currently holds control. Any reaction to a specific price level can be viewed as a swing, but the true strength of a price move is measured by how far it drives through imbalance and how it rejects levels through wicks. To avoid subjectivity in our schematic drawings, we follow a defined set of rules for marking the key swings. These swings help us extract the overall market direction based on those levels. Now, let me guide you through the process we use to identify these significant swings. In this instance, we observe a strong bearish move forming a low, which we mark on our schematic. To identify the next swing, we wait for price to break and close below the previous structure level. The highest point between these consecutive lows becomes our major high. With that, we can now precisely sketch the schematic. These plotted lines represent the major swings, while movements between them form the internal structure. It's essential to understand that our trend analysis mainly depends on these major swings. After this, we watch for the price to either push above the recent high or drop below the lower low. Again, the peak between these lows becomes our next major high. As we can see here, price breaks above the swing high, which signals a structural shift, indicating that sellers failed to hold the level and buyers have taken control, giving us a new high. Then, the market pushes above this new high again, and the lowest point between these highs is marked as our major low. Like I explained earlier, these are the key swings used for directional bias, while movements between them form the internal or minor structure, which can still offer meaningful trade signals and setups. For instance, this area marks the start of the most recent bearish impulsive move. However, the actual point of origin for the imbalance lies within these specific candles, making this the location of the supply order block. If the price comes back to this zone, it may present a high probability trading setup. Conversely, if the price breaks above this key supply level, it would suggest a notable weakening in bearish pressure, possibly signaling an upcoming trend reversal. In this example, we're looking at gold on the 4-hour chart. This represents the most recent market structure schematic. By shifting the schematic to the side, we can see that this structure perfectly illustrates the type of setup we seek when trading clear market movements, with defined direction and noticeable swing points. At this stage, we can apply smart money concepts to identify potential long setups in line with the prevailing bullish trend. However, if the price breaks below the latest swing low, we can look for short opportunities until the market reaches the next key demand zone. In contrast, take a look at this chart. It shows the most recent market structure schematic. The market is consistently testing and validating both the major swing highs and lows, giving us no definitive direction. This is when it's crucial to stay out of the market until a clear bias emerges. Recognizing when not to trade is just as vital as spotting the right moment to enter. Additionally, always keep an eye on major upcoming news events, as they can heavily influence price action regardless of the technical setup. When it comes to conducting effective multi-time frame analysis, The first step is to open the chart on the analysis time frame and outline the most recent market structure. As seen here, we clearly have a downward trend in USD, JPY on the 1-hour chart. The following step involves zooming out to the higher timeframes, such as the daily and weekly, to observe the broader picture. Our approach remains straightforward. We use the daily chart solely to determine the overall market context. We determine the overall market direction to verify whether our lower time frame analysis aligns with the bias of the higher time frames. Next, we identify daily key levels to understand how much space the price has before hitting a major support or resistance level. This also helps us pinpoint higher time frame targets. Now, let's look at the daily chart. What do we notice about the price action? The market had been in a sustained downtrend until it broke above the trend line after bouncing off this key support zone 3 times. Additionally, we observe a change of character, indicating buyers are stepping in and a potential counter-trend may develop. We also see that price has recently rejected a resistance level. At this point, there's no clear directional bias, as the order block could trigger a reversal. We need to wait and observe the next market moves. If price breaks above this supply zone, it suggests bullish strength, and we can consider long positions up to the next visible supply level. On the flip side, if price drops below the demand zone, it signals that sellers are back in control, and short setups can be targeted until the next demand level is reached. This highlights why higher time frames carry so much weight in the analysis. Trade execution takes place on the lower time frames, typically the 15-minute and 5-minute charts. Merging these lower time frames with the analysis time frames is mainly aimed at spotting trade setups, identifying entry triggers, and confirming the trade idea. Generally, if we mark our trading zones on the 4-hour and 1-hour charts, we shift down to the 15-minute and 5-minute charts to find optimal entry points into the market. On the AI dollar 1-hour chart, the schematic of recent swing movements doesn't clearly indicate a trend. So let's switch to the 4-hour time frame to evaluate further. On the 4-hour chart, we can observe a clean bearish trend when we outline all the visible swings. Now let's integrate smart money concepts into this setup. There's a mitigated fair value gap that recently pushed the price downward. Upon closer inspection, we can identify a significant market structure level that has acted as both support and resistance several times, suggesting there's considerable liquidity resting above it. Additionally, we see an unmitigated order block, presenting a strong supply zone that may provide shorting opportunities. However, we cannot execute trades directly at this order block for 2 main reasons. 1, it's a broad zone which makes precision entries difficult, and 2, the market has shown indecision by failing to decisively break below this level. Therefore, the best approach would be to zoom into a lower time frame for confirmation, enabling us to catch a better entry price. You can apply different trade setups on lower time frames as discussed earlier. Since this is a 4-hour level, we'll need to move to the 15-minute chart to look for a valid entry opportunity. On the 15-minute chart, we can spot a double top reversal pattern forming right at the key zone, followed by a strong bearish move that created a clear imbalance. This move confirms the entry of sellers into the market, suggesting a potential reversal. However, entering immediately would mean using a wide stop loss, which compromises our risk management. Instead, we should wait for a pullback to get a better entry price. Even if we consider the 4 bullish candles prior to the bearish drop as our supply zone, the trade still offers a favorable risk-to-reward ratio. Our target would be the demand area ahead, and our stop loss should be placed just above the double top. If price breaks and closes above that level, it indicates the 4-hour supply zone has failed to hold, and we would exit the trade with a loss. Now, although this trade setup has already played out in historical data, the takeaway is clear. Regardless of outcome, it was a quality trade. Why? Because we aligned multiple price action confirmations, like puzzle pieces, to anticipate the market's next move with confidence. We identified that the higher time frame bias was bearish. After marking our key supply zone, we patiently waited for price to enter that area. Once the market showed clear signs of bearish momentum, we executed the trade, basing our entry on a calculated risk-to-reward ratio. This approach ensures discipline and precision in our trading decisions. Here on the Dow Jones 1-hour time frame, we can clearly observe a bullish trend, with the market consistently forming higher highs and higher lows. Now the key question is, where can we enter this bullish trend as smart money traders? Our first step is to identify a fair value gap. By applying the Fibonacci retracement tool, we notice that this FVG aligns perfectly between the 61.8% and 78.6% retracement levels, a prime area of interest. If the price retraces into this zone, that's our cue to scale down to the lower time frames. So let's drop down to the 5-minute chart and take a closer look at the price action for possible entry confirmation. Now on the 5-minute chart, we're looking at a strong downtrend. The market has rejected the demand area with a clear double bottom reversal pattern, solid structure, but still no valid reason to go long just yet. We've identified a nearby fair value gap and a robust supply zone sitting ahead of price. This zone could potentially drive the market even lower. However, everything shifts when we get a change of character. This happens once the price breaks above the supply area. That's our signal. Supply is no longer in control, and momentum may now favor the bulls, aligning with the higher time frame trend. So how do we enter the market from here? We wait for the market to make its next move and form a fair value gap. The candle that creates this imbalance becomes our designated demand zone. Based on that, we open a long position slightly above the order block and set our stop loss just below the most recent swing low. As the market progresses, it forms another valid order block. Without cancelling the initial trade, we execute a second long entry, anticipating that price might still revisit this new area and trigger our setup. However, it's crucial to understand that this second entry carries additional risk and could result in a loss. Let's observe the outcome. In this scenario, the second trade gets triggered and plays out profitably. But the key takeaway here isn't just the win, it's the importance of solid risk management. One of the golden rules in trading is to risk only about 2 to 3% of your total capital per trade. This approach protects your account from significant drawdowns even if a trade goes against you. The objective isn't just to make profits, it's to protect and grow your capital over time. By consistently limiting your risk, you maintain the ability to recover from setbacks and keep trading with clarity and control. Remember, effective risk management is one of the foundations of long-term success in the markets. That's it for today. Thanks for tuning in. I hope you found value in today's video. If you did, go ahead and hit that like button to show your support, it really helps us out. And if you're new to the channel, consider subscribing so you don't miss future content. Thanks for watching, and I'll see you in the next episode.